Welcome to the Ellsworth Advisors monthly update for October 2022. I'm Kelly Keenan, this is Cameron Mealy, and today we will discuss the latest economic news, what happened in the last month or so, and then also discuss how the markets have fared and how our portfolio has performed throughout the month. So Cameron, let's kick it off, a little economic update.
All right, Kelly, we've got some interesting numbers here. We've got some very good information on the economic front. We've got some very disappointing information on the economic front. So first, let's start out with good information. So on October 27th, the Bureau of Economic Analysis came out with their first or advanced estimate of third quarter GDP. That number came in at a 2.6% increase in the third quarter, annualized increase, of course, which means if you remember earlier, we saw negative first quarter, negative second quarter, and then all of a sudden a blowout. I mean, 2.6% in a mature economy like the U.S. is a very strong number. Typical growth we're looking for in the U.S. economy is about 2% per year. So 2.6% on a $30 trillion economy is quite an impressive number. What's even more impressive is, as of October 28th, the Atlanta Fed's GDP Now growth model projects that fourth quarter GDP will increase to 3.1% annual return. So, I mean, if you look at it, two negative quarters, I was convinced, and I said it many times on these films, that we were in a recession. But now all of a sudden, a 2.6% increase in the third quarter, 3.1% increase, shows a really strong fourth quarter. And obviously, I think what it really shows is the resiliency of the U.S. economy, U.S. consumers, U.S. businesses. I still think there's probably a lot of cash out there, and consumers are spending it, businesses are spending it. Despite the higher interest rates, businesses continue to invest. So I think it'll be really interesting to see how the holiday shopping season, how the retail season does in the fourth quarter, see how strong the consumer actually is. So that's good news. What does this reinforce? This does reinforce now the very strong likelihood that the Fed is going to increase their target Fed funds rate by 70 basis points. We're shooting this video on November 1st. The Fed is meeting November 1st and 2nd, so full expectation is that tomorrow there'll be another 75 basis point increase. That'll be 300 basis points that the Fed has increased their target rate this year. The Fed then meets again December 13th and 14th. Significant probability that they raise rates even more. So we could be looking at a 350 basis point increase this year.
Well, yeah, my assumption is they'll raise tomorrow 75 basis points. December will be another 0.5%. That gets them up around 4.5%. And there is some consensus out there that they may hold off a little bit before the next hike, kind of see their actions.
See how
are they affecting the economy?
Yep.
With the GDP numbers, yeah, I mean, the technical definition of a recession is two negative quarters. We had a positive quarter. There's a little bit behind that GDP number. Exports were a blowout number, which probably added 2.6% to the GDP number. So how strong is GDP? You can always slice and dice it. Obviously, the other components of a recession, which many strategists have been saying, no, we're not in recession because we're not seeing strains on employment, we're not seeing consumer confidence numbers down, we're not seeing a slowdown in productivity. Mm-hmm. Those elements haven't been there, and that's kind of the cohort of strategists and economists saying that no, we're not in recession now. The recession is yet to come sometime in 23 when the Fed's actions actually start taking effect.
Yep.
And the reality is we're starting to see employment picture change a little bit, softening a little bit. I mean, we're still a low
robust
unemployment number.
Yes.
There's still a lot of open jobs, but that has definitely cooled down. So that may be a trend that could be continuing. We're seeing some stress in different areas of the economy, specifically the tech world. A lot of stress with the tech companies, with third quarter earnings that have been announced. It's definitely been a mixed bag, and it's really come down to a company by company basis. And what we are seeing is companies that have been able to manage their cash flows, that run good solid businesses, they're not over leveraged. Those companies are still making money, they're still doing well.
And they're the ones that have been rallying.
They're being rewarded, and if your company's missing numbers or the outlook isn't so good,
Yep.
those companies are being punished. So that's kind of takes us to where we're at today. What else do you have on the economic news? And I'll dive into the markets.
So we just talked about GDP of the U.S. Anybody who has seen our videos before knows that we've had a strong bias for the U.S. economy for probably at least the last 7 years. So while the U.S. picture looks very rosy compared to the historical standard of 2% GDP growth, the rest of the world is not tracking with the U.S. Something I want to talk about. So this is the World Economic Outlook 2023. This is from the International Monetary Fund. This is the World Economic Outlook in October. This is a quote I'm going to read from the International Monetary Fund's World Economic Outlook. Aside from the global financial crisis and the peak of the COVID-19 pandemic, this is the weakest growth profile since 2001, the IMF said in its World Economic Outlook published Tuesday. Its GDP estimate for this year remains steady at 3.2%, which was down from 6% seen in 2021. Here's a direct quote. This is the worst is yet to come, and for many people, 2023 will feel like a recession, the report says, echoing warnings from the United Nations, the World Bank, and many global CEOs. So obviously, the International Monetary Fund is concerned about global economic growth, and where are we really seeing that, which is not surprising right now, is the Eurozone. The Eurozone is in trouble. Whether it's the Russian invasion of Ukraine, it's the lack of energy infrastructure spending, this strong push to go green and get rid of fossil fuels and nuclear. It's going to be a very tough winter in Europe. And that played out with the most recent Eurozone inflation report, which showed in the Eurozone, October inflation was 10.7% year over year. We've talked about historically high inflation in the U.S. at 8.2%. 10.7%. This is from the Wall Street Journal. The European Union Statistics Agency Monday said consumer prices were 10.7% higher in October than a year earlier, the fastest rate of increase since records began in 1997, 2 years before the euro was launched. However, national records go back even further, and Germany's measure of inflation was the highest since December 1951.
Yeah. Once again, the U.S. is kind of the furthest along. They haven't been hit the hardest. A couple dynamics coming into play there. U.S. has the world reserve currency, so that puts pressure on prices in the rest of the world. That makes commodities more expensive for the rest of the world. They're definitely, feeling that pain. The war in Europe definitely has changed their energy outlook. And even on the agriculture side, I guess we really haven't seen that come into play yet. And then we go to the other side of the world, talking about Asia, which I know you have some information there. China specifically, they still have not really come out of lockdown. So you're looking at a really loss of consumers because of China, and once again that caused supply chain issues. Once again, that added to the inflationary pressures. So what do you have on China there?
So interesting, I was reading, this is from Market Watch on October 29th. I'm just going to summarize. It's a great article. You'll see the article below referenced here. But essentially the point of the story was, if you look at Russia in the 50s and 60s, there was a technology race between the US and Russia. By the 1970s, Russian technology had really fallen far behind the US. And because of that, because Soviet Union was a dictatorship. And so the basis of this article was, if you look at Russian growth, it's always been about, people, low-cost labor, government support, and frankly, stealing intellectual property. China went from a more of a democratic economy under the former president, Hu Jintao, who I think everybody, if you've seen the news, you saw how Hu Jintao, who was the president in 2012 before Xi Jinping became president in his first term, was basically in the middle of the Communist Party convention. Security came up, escorted him out, and really that was Xi Jinping's kind of stamp on that it's his party, he controls it. He's now going to be president of China for a third term, which is unprecedented. It feels like China is slipping into a dictatorship. And so the basis of this article was, if you look at the Soviet Union and you look at China, China really is not innovating like they used to. You have an economy now, you have an education class, you have a workforce, that is more concerned with saying the right things to leadership. You have a lot of regression. You have a lot of censorship. You have this zero, COVID lockdown. China's not the same place it was 5 years ago. And so you can see it in their innovation that they are starting to fall behind. And, the biggest telling difference is it's hard to innovate in a dictatorship, in a country without freedom, where the government controls everything, where there aren't rewards for speaking out or for going a different path.
Right. And, it's really a closed economy or a one-party leadership there. So you do get a restriction on, variation of ideas, innovation. And, the reality long-term for China, they have a lot of challenges ahead of them. They have a shrinking population. I read an article, in 50 years, the U.S. will probably have a larger population than China. So
it is amazing. I mean, 10 years ago, it wasn't, it's almost like Tiger Woods and majors. It wasn't if he was going to be the all-time major king, it was when. It has always been, China will surpass the U.S. in terms of GDP. It's just a matter of when. Now it doesn't look like that's going to happen.
Well, they should. They have 3 times as many people as we do. No, actually maybe 4 times as many people as we do. So obviously they should have a higher GDP, but they don't. They're still, well behind us. And, that's really a subject for another day. The reality is, we know what's going on over there. We try to avoid investing directly in China.
Mm-hmm.
I don't want to be a business partner with the Communist Party of China. But the reality is, but we'll own companies that do business in China. Yeah, if they're going to buy our goods and services, why not? Yep. So, but big picture, the reality is the U.S. has been holding up economically. The rest of the world definitely has been struggling more so than we have. And really the real, this whole thing's not over. We had a great month last month, and I'm going to kind of dovetail a little bit into what's happening in the markets. So since the beginning of the year.
But our U.S. bias, at least on the near-term horizon, isn't going anywhere.
No.
Not based on what we're seeing globally.
Yeah, it's too soon to start investing internationally at this point. I just don't, I like the, we can find as many good opportunities in the U.S. as we can internationally. And when you look at the market, year to date, the Dow Jones, or I'm going to start with the S&P. So the broadest based large company stocks in the U.S. down 18.76%. The Dow Jones down 9.92%. And we had a great rally this month. So October was a great month. The S&P was up 8%. The Dow Jones up 13.95%. So a big move this month. But the reality is we came off of a really bad September, yep, which kind of mirrored June. So since the beginning of the year, we had the market going down, hit a low in June. The S&P was down around 26% in June. We had decent months, a rally in July, kind of a weakish August, September, mm-hmm, and then we had then we had weakness in September, which we reapproached those lows, and really on the S&P exceeded them slightly. So, down 26, down 28. So kind of revisit those. Now we have another monster rally in October, and I'm not confident that this is the end of the story. We still have a couple more rate hikes out of the Fed, and the Fed's going to keep on going until they see the inflation cooling down.
It's their number one concern.
So that's their biggest concern. We need some weakness on the inflation side. And until we see that, the chance of revisiting those lows or exceeding those lows is a real good probability, especially if we end up slipping into recession first, second, third quarter next year. Okay, probably if we start entering a recession, typically the market's going to bottom before the worst of the economic numbers come to reality, or before really the economy bottoms out. The market will have bottomed out long before that. So the expectation is, there's a pretty good chance we may see another leg down in the market, either revisiting lows or maybe exceeding those. But we don't know. I mean, the reality is new positive news could come up, or the Fed could stop raising interest rates. All of a sudden, inflation drops, which is kind of unlikely. But we can't just step away and wait for those lows. We don't know when they're going to happen. The key is where we're positioned to be so that when we do hit those bottoms, we come out and we're in the right stocks that are going to perform well in a different economic environment, an economic environment where we have real interest rates that are more normalized versus 0 to no interest rates the past 12 years. And the other reality, this is a major shift in the market like we saw in 2001, 2002, or 08, 09. And what do we know is the leaders going into those downturns were not the leaders coming out. So there'll be a whole different crop of stocks that really lead the way. And it's going to be more characterized by, once again, kind of your real economy stocks, your industrials, your energy companies, your financials. Those are the companies that are probably going to lead the way out of this. So that's really where we've been trying to reposition the portfolios, looking for companies that we know can create real profits, real cash flow, and can manage their debt loads. So it's going to be a different picture coming out of it. Going back to the numbers, like I said, Dow Jones up 13.95. The Dow, as a refresher, is really represents 30 stocks. Generally, you're looking at larger multinational industrial-oriented companies. The S&P 500 up 8%, pretty strong, but did lag because there's a lot of technology in there, and it's a more diverse pool of stocks that they measure that index with. The NASDAQ only regained 3.9%. The Russell 2000, which measures small company stocks, gained 10.95. On the international side, things were really good here internationally. Developed world up 5.3. Emerging markets still down 3.15. The emerging market story, obviously, if the U.S. is challenged, that's going to hurt your smaller emerging countries. China being a big part of that index, obviously they've not come out of their lockdowns. Their economy is still challenged right now. The only thing that's working in the emerging market world are more your South American countries that have a lot of natural resources. Those countries will probably do just fine through this. On a year-to-date basis, like I said, the Dow Jones down 9.92. The S&P down 18.76. So technically the S&P is no longer in bear market territory since it's not down 20% anymore. NASDAQ still down 29.77%. Small caps down 17.75. International markets, right? Once again, the EAFE down 25.09 and the emerging markets down 31.16. So, there's a lot. The international's got a long way to go. Our portfolios, I'd say, did all right. The growth with income portfolio in October up 7.2%. Year-to-date still down about 11.2%. Big gainers, no surprise. Exxon up 27%. EOG up 23%. Honeywell up 22%. Nucor up 22.8%. Visa up 16.6%. Cisco 14.6%. Disney actually finally picked up 13%. So a little bit of a theme there. Oil, energy, your kind of old world economy, Honeywell, Nucor, mature companies that have broad product bases. That's what's going to work. Good, solid balance sheets. Laggards last month, gold retreated about 1.8%. CVS down 0.7%. So pretty much almost made money across the board in there, just not tons of money. Year to date, Exxon's still our big gainer, up 80%. Nucor up 15%. Pepsi hanging in there, up 4.5%. J&J up 1.7%. The detractors from the portfolio this year, NVIDIA, which fortunately we took a lot of money off the table early in the year. We made tons of money in there, but with the remaining balance down 54% year to date. Nike, I think a lot of this is China issues, down 44%. Disney, even though we had a nice month, still down about 30%. And Lennar, the home builder, down 30%. Lennar's an interesting story. I still have a lot of confidence in there. I think long term that's going to be a great play for us. In dividend yield, October, up 8%, so a good solid month there. Year to date, we're only down 9.3%. Big gainers, once again, Caterpillar, 31.9%. McDonald's, 18.2%. Merck up 17.5%. Cisco, 13.6%. 3M, 13.8%, so some nice gainers there. Our detractors, Prudential down 4.7%, so not too bad there. Southern Company down 3.7%. Verizon down 1.6%. Year to date, our big gainers, Merck up 32%. British American Tobacco up 5.9, Caterpillar up 4.7, Consolidated Edison up about 3.1. Laggards, Intel down 44.8. BlackRock, once again, another stock that we've made a lot of money in. We took some money off the table, but remaining balance down 28% there. Pru struggled down 33%, and then 3M, nice bounce back this month, but still down 29%. Price potential, which is more of our growthy portfolio. October, disappointing month, only up 4.5%. Year to date, we're down 16. So we've lost a little bit of ground in here. Visa up 16.6, so that was nice. Humana up 15 for the month. Stryker up 13.2. Boston Scientific up 11.3. From a laggard standpoint, Facebook, also known as Meta, that's been a thorn in our side. A lot of debate on with the investment committee as to what we should do there. That's down 31%. Lithium Motors down 7.6. CarMax down 4.6. Once again, those two car dealer stocks, we've done very well in them since we've held them. Just giving a little bit back at this point in time. Year to date, Humana's up 20% for us. Boston Scientific up 1.5%. Once again, Meta popping up as a big drag on the portfolio, down 72% year to date. Google down 35%. Comcast down 37%. Microsoft giving up 31%. In our small cap portfolio, October up 10%. Year to date, small caps, and we're only down 11.75. I'm really happy with what's been going on with this portfolio. And typically with your smaller companies, in this type of environment, I think they're going to do pretty well. One is with less globalization, that's actually a big benefit, and we're starting to see that. So, we could see good things happen with small caps coming out of this. A little different than what we've seen in it's called intermediate, before our last big recession in 08, 09, small caps generally didn't really bounce out real well out of market pullbacks. This time it could be a little different story this time through. October gainers, here's some big numbers. Richardson Electronics up 59%. Haynes International, which they do production for aerospace and chemical processing, up 40%. Hackett up 24%. Consolidated Water up 20%. On the downside for the month, Mtron Industries down 32%. Rubicon down 5%, so not too bad there. Year-to-date gainers, Lantheus still up 153%. These are stocks that we still hold. Clearfield up about 66%. Excel Services up 25%. With what we're still holding, we only have two that are only one position that's down that we still hold. That's QCRH, which is a holding company for Quad City Bank, and that's down 9.67%. So it's a decent month. We didn't blow it out of the water. We're still hanging there pretty well for year to date. Our fixed income, we've been sitting in a lot of treasury bonds, which we've been able to get in that 4% range going out to next summer, or 12 months or a little bit less than 12 months. So we're not really getting hurt on the bond front, and it's really I kind of expect more of the same. I wouldn't be surprised if we have another decent pullback here in the next couple months. It would make sense that it happens between the next two rate hikes, but we'll have to wait and see. Key is hang on, and we're kind of taking advantage of this rally to reposition for monthly needs from clients.
So thank you very much for the trust you have in us. We'll talk to you again in December, and from all of us at Ellsworth Advisors to you and your family, happy Thanksgiving. Hope you have a great one. If you have any questions, you need anything, please feel free to give us a call.
Thank you.
Thank you.